Good day to all of you, and thank you for joining us for our second Outcome Matters session in 2022. My name is Willem van Zyl, Channel Director for the MFP channel, and I will be your host for today's session. Before we start with the session, I would like to inform you about the following. Please note that we have applied for continuous professional development points. I know that this is important to you. It is therefore important to please watch the full session and add your ID to the CPD section so that we can verify your attendance. The CPD certificates will be mailed to you after the Financial Planning Institute's accreditation is finalized. In terms of housekeeping, I would like to remind you to post any questions that you may have for the speakers in the questions and answers section. You are welcome to use the chat function during the sessions. Our team will deal with these questions, and if there are any questions or comments that I can't answer or respond to right away, they will get back to you as soon as possible. What a year this has been so far. In the beginning of the year, we thought we were confronted only with a pandemic that created chaos in the world. Then came February, and we saw the start of the war in Eastern Europe, which is having an impact on fuel and food prices in South Africa. We also saw the havoc that extreme weather created in KwaZulu-Natal recently. And to top it all, we are officially in the fifth wave of COVID, all whilst an important social media platform that influences people's behavior and conduct, the way they think about life, and for example investments, was bought and now belongs to a guy initially from Pretoria. It just goes to show that if you want to get somewhere in life, you probably need to get out of Pretoria. The ordinary man in the street is under pressure, and he wants certainty in a world that can only guarantee one thing, and that is continuous uncertainty. What gives me comfort, though, is that the role of a financial advisor has just become so much more important, as clients look to us to provide them with guidance on what to do. You as a financial advisor might also have this need for certainty, and it's therefore comforting to know that we have various teams of specialists assisting us on our journey with the client. Today is all about that. But before I hand over to the team, I would like to, on behalf of MFP and the Momentum Investments team, thank you for your support since the launch of the new Houseview solutions. We have seen month-on-month growth in our MFP model portfolio support, the Momentum Flexible Income, and our Momentum Houseview Fund of Funds. At the end of March, we celebrated our first anniversary of our MFP model portfolios, and we have a healthy 632 million assets under management, supported by some 136 advisors. Then, looking at the Momentum Collective investments, we have seen steady growth in our Momentum Focus Fund of Funds Houseview range, with a 100 million increase in gross flows year to date, comparatively to the same period in F21. The fixed income range, however, has remained relatively flat, with a small reduction in flows compared to F21. We hope that this partnership with you will yield positive results, and through your continued support, we are sure that we will grow from strength to strength. As per our standard way of work, we will provide you with detailed feedback and fund positioning from our portfolio managers regarding our Houseview solutions. And we trust that you will continue to support us as we share information that will assist you with your investment advice value proposition. In our agenda, we have mentioned that joining us today for the first time in the Outcome Matters session is Faria Adam, Head of Product Solutions at Momentum Investments. Faria will be sharing with you how Momentum Investments has reimagined retirement income by launching the Guaranteed Annuity Portfolio that will expand your advice opportunity set and thereby contribute to better client outcomes. One of the major challenges facing most advisors today is the low return environment, which makes living annuities tough to advise on. Faria will be explaining how we can all reimagine our retirement income planning. It is nearly time to hand over to our portfolio managers. I would, however, like to briefly touch on a question that has come up in various engagements with the advisors since the launch of the Houseview. There seems to be confusion as to the similarities and differences between our MFP model portfolios and our fund of funds. It is important to remember that both these solutions are managed in accordance with the outcome-based investment philosophy, and that we do not favor one above the other. We have model portfolios as well as fund of funds to cater for all possible client needs and to offer the best of both worlds as part of a holistic overview offering. Both set of solutions aim to meet the client objectives over a specific time horizon and can have slightly different journeys in achieving their objectives. As part of the Momentum philosophy, Momentum Investment aims to identify investment managers with good and reputable processes that fulfill the specific investment strategy component on which they are mandated to deliver. Even though both investment teams leverage off the same underlying investment research, it does not mean that the same manager will always be used in the execution of the strategies between the two ranges of funds. Depending on the objectives and the circumstances, a specific manager might be more suitable in the model portfolio construction at a specific point in time, and the same applies to the fund of funds. One of the major differences between model portfolios and fund of funds is that model portfolios are not a legal entity, but a fund of funds structure is, as it is a collective investment scheme or unit trust in its own right. Because of the difference in structure, there could be a CGT impact in a model portfolio when changes are made during the ongoing management of the funds. On the other hand, in a fund of funds solutions, a change in underlying funds or rebalancing will not trigger a capital gains tax event in the hand of the investor. It is important to note the different tax treatment in various investment wrappers as well. Because a model portfolio is not a legal entity, investors also do not hold units in a model portfolio, but rather directly in the underlying funds used in the construction of the portfolio, which leads to increased transparency. Investors can see the underlying funds in which they are investing, which is different from a fund of funds structure, where investors purchase units in the fund itself. Our fund specialists have drafted a document that explains these differences in detail, and it will be made available to you shortly. I will now hand over to our portfolio managers. First up is Ronnie Borman, Portfolio Manager of the Focus Fund of Funds. He will provide a brief economic overview as well as the update on the Focus Fund of Funds in the Houseview solutions. Then we will hear from Dean D'Souza, Portfolio Manager of the MFP Model Portfolios, who will provide us with an update on the models, followed by Ian Scott, Head of Fixed Income, who will discuss the yield curves compared to central banks. I trust that you will enjoy today's session with us. Let's hear what they have to say. Over to you, Ronnie.
Good day, and welcome to this Q1 update for the Momentum Focus Fund of Funds. I'm Ronnie Borman, and will be joined later by my colleague and co-portfolio manager, Dean D'Souza, who will cover the MFP Focus model portfolios in more detail. In today's session, I will use this opportunity to give you a brief update on markets over the last quarter and 12 months and how they translated into our investment delivery of our funds. I will unpack the performance briefly and close out with our fund-of-fund positioning and our outlook for the near future. We trust this update will assist you as our valued partners during your next client engagement. At our last webinar, the focus was tilted to inflation, the Fed's potential policy tightening, and China's disappointing growth. While none of these concerns have diminished since then, news flow has certainly been dominated by Russia's invasion of the Ukraine. And from a humanitarian perspective, we sympathize deeply with especially everyone affected directly by the war. Now, from a market perspective, the invasion has caused a global shock, followed soon after by unprecedented sanctions. The implications of the war and the sanctions have quickly fed through into markets, which saw equities decline and bond yields rise. Commodity prices soared, given Russia is a key producer of several important commodities, including oil, gas, and wheat. The conflict contributed to a further surge in inflation, as well as supply chain disruptions. In addition, Chinese equities were negatively affected by renewed COVID-19 outbreaks, leading to new lockdowns in some major cities. China's zero-COVID policy is certainly polarizing, if nothing else, considering the world has largely learned to live with COVID. Now, as expected, volatility increased late in the quarter. Frozen assets and the exclusion from the global financial system saw Russian equities and their currency nosedive prior to being removed from the MSCI Emerging Market Index entirely on the 9th of March. US inflation hit 7.9% in Feb, and equities declined as the Fed raised interest rates by a further 25 basis points, with more rate hikes likely to come. In the Eurozone, shares fell sharply in the quarter, given close economic ties with the Ukraine and Russia, particularly when it comes to the reliance on Russian oil and gas. Emerging market equities in general were firmly down given these developments, but net commodity exporters have posted sizable gains. Closer to home, however, economic challenges will persist with increased inflationary pressures driven by fuel and food price increases. Although lockdowns have eased, load shedding is looming and the winter months are coming, which will be a further headwind to economic growth and sentiment. The recent floods in KZN and damage to key infrastructure such as bridges and roads are also expected to have a negative impact. When looking at how the economic backdrop impacted market returns, and contrary to many other emerging market fortunes, the South African market broadly ended the quarter in positive territory. SA equities posted a decent return of 6.7% in the first quarter, driven by resources, which was up 19%, financials up 20%, and industrials were sharply negative at negative 13%, led predominantly by further regulatory challenges for Naspers and Prosus in particular. Nominal and inflation-linked bonds came under pressure as the yield curve flattened in March, with the war deepening stagflationary concerns. Cash managed a 1% return. Over 12 months, the majority of these asset classes, however, still enjoy healthy double-digit returns. Turning our attention abroad, the general risk-off environment, coupled with a strengthening rand, which was up some 8.5% on the back of strong commodity prices, saw all global asset classes falling into deep negative territory in local currency terms for the 3 months to March. Global equities retreated 12.2%, with developed markets only slightly ahead of emerging markets. Within developed markets, Europe and the UK struggled, given particularly their strong reliance on energy from Russia. Global bonds continued to slide, with US inflation at 40-year highs, rising interest rates, and the Fed formally signaling a reduction in its debt holdings in the coming months. Similarly, the ECB took an equally hawkish stance, announcing a possible end to tapering by the end of the third quarter of 2022. Despite some decent asset class returns in the past 2 years, the longer 5-year view of asset classes still indicate that not all asset classes or sub-asset classes are outpacing inflation by lofty margins. And some, such as local property, are still deep underwater over this period. Turning our attention back to the local environment, we can see that inflation in the yellow line is comfortably outpacing cash returns, and the STEFI effectively offering negative real returns on a 12-month basis. We expect a further 325 basis points hikes this year, with the potential of a 50 basis point hike not ruled out, as the SAR potentially aims to get ahead of local inflation and remain competitive relative to other emerging markets. Despite the challenging and volatile political and market environment, a well-diversified multi-asset investment such as the Focus range remains one of the best defenses against inflation for the long-term investor. Now, taking a longer-term view, the average ASISA SA multi-asset class fund is outperforming inflation on a rolling 5-year basis. Although, as we have discussed in the past, the elevated real returns of the mid-2000s and the 2013 to 2016 era have moderated substantially. Turning our attention now to the returns of the Momentum Focus Fund of Fund range, we can see that it has been a muted quarter, with returns largely flat but well positioned relative to the respective ASISA peer groups, with first and second quartile ranking performances across the range. Over 1 year to March, the funds remain comfortably ahead of the respective peer group averages as well as their inflation-linked benchmarks. Key contributors to these double-digit returns have been our tactical overweight tilts to local equity, nominal and inflation-linked bonds, global property, and careful management of our exposure to global equity over the past 12 months. Similarly, our underweight exposures to global bonds and local cash have added on a relative basis, while underweight exposures to local listed property has been a detractor. Now, the recovery in financial markets have been very relevant for our solutions, and we've experienced an exceptionally strong 24 months post-COVID. As outcome-based investors, we are pleased by these returns for clients, which would have gone a long way to offset the low growth environment in the preceding 5 years, where local growth asset classes have struggled to keep pace with cash. And while it's not an explicit objective in an OBI context, we appreciate that being peer credible does go a long way in a client discussion. Looking at our Focus 3 to 7 fund of funds, we see that on a cumulative basis, the funds have outpaced their peer group averages by between 6.2 and 12% over the past 24 months, which speaks directly to the ability of these solutions and the importance of a robust and well-diversified strategic asset allocation, strategy, and manager selection process. Focusing for a moment on the delivery of the underlying funds in the range over the last 12 months, we see that all the local components have contributed with strong positive returns. The local equity blend and the local property fund had the highest absolute returns, but ended the period marginally behind indices. Both these funds have a slightly longer duration to their alpha profiles and remain very well on track. Our property fund is tilted to high quality counters with strong balance sheets and low debt levels. The fixed income solutions, on the other hand, have managed to deliver very noteworthy performance while simultaneously outperforming their respective benchmarks, as indicated in blue. The Momentum SA Flexible Fixed Interest Fund benefited from its exposure to listed property and ILBs, as well as an overweight exposure to the 12-year plus sector of the yield curve, which happened to be the best performing sector of the ALB at 17.8% for the 12 months. As I alluded to earlier, the equity blend in the Focus Fund of Fund range is constructed to provide a stable alpha profile, ideally over a rolling 3-year investment horizon. The 6 underlying profiles are blended for deliberate exposures to quality, value, and momentum risk premia in the local market. As this chart shows, the blend has been very successful in delivering consistent alpha over its benchmark, the JSE All-Z Capswix Index. The next graph shows the performance of the blend and its constituents over various periods since inception. We remain comfortable with this lineup of equity managers, and each of them have been successful in delivering diversified returns and alpha over time. Next, we look at the global components in the Fund of Fund range. We can see positive contributions from the Global Developed Markets Equity Fund, as well as our passive global property allocation, despite returns being curtailed somewhat by the strong negative first quarter of 2022 for these asset classes. The Global Equity Fund trailed its benchmark, owing to increased volatility and underweight exposures to US large cap tech stocks relative to the index over the 12-month period. The Emerging Market Equity Fund outperformed its index despite strong negative returns owing to the Fed's hawkish shift in policy, coupled with China's tech crackdown during 2021 and slowing growth prospects. Over the same period, the Momentum Global Fixed Income Fund detracted as rising but still low yields and high valuations saw global bonds remain on the back foot. Turning our attention to the future, we expect a continuing rise in inflation and tighter monetary policy conditions. Economic growth, although still positive, is starting to moderate due to higher interest rates and continued supply chain disruptions, all of which are exacerbated by the current war in Ukraine. Overall, commodity and gold producers are set to benefit, and there is still value to be had in local equities. We are therefore tilted to overweight positions in local equities, as well as local fixed income, especially given high real yields currently on offer. We remain underweight to local property, particularly given the challenges related to vacancies in the office sector, although retail and industrials have shown signs of recovery. We have adopted a more neutral stance on global equity and tilted the funds marginally to developed markets, given the challenges currently being faced by the emerging market sector. The outlook for global fixed income remains unattractive, and this is reflected in our sizable underweight positions. We do, however, continue to monitor the market closely for pockets that offer better entry points going forward. Given the relaxation of Regulation 28 or foreign exchange controls, we will look to add to our global exposure in a systematic and responsible manner over time. Looking now at our current positioning from a risk perspective, the predicted 12-month capital at risk is therefore still well within the strategic targets defined for each fund and risk profile, leaving us with sufficient room to maneuver markets during these very volatile times. As always, the funds remain purposefully positioned and well diversified for the prevailing conditions, with our eye firmly on the long-term objectives of our clients. I thank you for your time, and until next time, please take care.
Welcome to the Quarter 1 update on the MFP Focus model portfolios. Before I jump into my presentation, it gives me great pleasure to introduce to you the power of balance that will help you future-proof your practice. Introducing Equilibrium.
In 2021, it was estimated that between 15% and 20% of retail investments in South Africa were either being managed or advised by a discretionary fund manager. Momentum's discretionary fund manager was established in 2008 and is part of Momentum Metropolitan Holdings Limited. In this time, we built up our assets under management to 13.5 billion rand, of which 7.3 billion came in less than 3 years. We believe the rise of the discretionary fund manager, both in South Africa and globally, was driven by two elements. Firstly, many advice practices lack the in-house investment expertise an asset manager can offer, and this imbalance was exacerbated by the rampant increase in size and complexity of investment markets. By outsourcing these skills to an expert and using the efficiencies that a Category 2 license brings, advisors could remove the investment compliance risk from their practice. Secondly, what worked for advice practices yesterday won't fit in the future of financial planning. Financial advisor practices need an easier way to report to their clients, to manage their investment books, to reduce their investment compliance risk, and to streamline their administration to save time and money.
While the need for investment management capabilities and increased efficiency established the need for change, what we could offer advice practices showcased the value of change. We could offer independence in terms of platform and fund manager selection, access to different set of investment manager expertise, and the ability to create continuity in advice practices. Financial advisor practices have evolved and they've embraced these changes. We've also reached the stage in our journey to evolve. Introducing Equilibrium.
I wanted you to be the first to hear our exciting news. Your partner in discretionary fund management has a new name, Equilibrium. The new name and branding are inspired by our goal of providing you with the best-in-class, independent DFM services while giving you the security of knowing that we are backed by a major listed financial services group. For those of you inevitably wondering whether there's been a mix-up with the slides, ready to ferociously type a comment in the chat box, I can assure you that we are exactly where we want to be. With the MFP Focus model portfolios reaching their 1-year track record, I thought I would take this opportunity to thank each and every one of you for the tremendous support we've seen over the past 12 months, one of the most volatile and eventful periods in investment markets of recent memory. Since launching these portfolios in April last year, the assets under management in the portfolios have grown from zero to just over 637 million rands, while the number of active planners is already greater than 130. Over the same period, your clients have been rewarded with returns of between 10 and 14.5%, depending on which portfolios they were invested in, the drivers of which we will unpack a bit later. While past returns are in no way a guide to future returns, you can be assured that we will apply the same level of rigor and care to your portfolios as we have done over the last 12 months, with the aim of helping you and your clients achieve their financial objectives. To put more context to my earlier comment, this slide shows some of the most impactful events over the last 12 months. With the global growth recovery in full swing as a result of unprecedented stimulus measures and corporate earnings very strong, Q2 of 2021 went fairly smoothly for investors. You might also be surprised to learn that it was also around this time that concerns started to surface around the buildup of Russian troops at the Ukrainian border, which, as we know now, escalated into a full-scale invasion in February this year. The quarter did, however, culminate in the discovery of the first case of the COVID-19 Delta variant, a variant which would wreak havoc across the globe and affect risk appetite all the way through to September. And as if the Delta variant wasn't enough, Q3 of 2021 started with a number of impactful events, most notably the KZN riots, which significantly impacted GDP growth for South Africa, while the ongoing regulatory crackdown in China on the technology and education sectors sent the Naspers and Prosus share prices through the floor, and the floods across Europe sent energy prices through the roof. In August 2021, PGM prices and consequently the share prices of PGM miners came under severe pressure as the automotive industry felt the effect of constrained supply chains, with vehicle production slumping due to the inaccessibility of microchips. The quarter concluded in a culmination of risks as a very hawkish statement from the Fed amid climbing COVID-19 cases dented global risk appetite and ended a winning streak in global equity, with the Evergrande debacle in China exacerbating risk appetite towards emerging markets. The year, however, ended strongly in Q4 as markets shook off a poor September with a very positive earnings season and a recovery in commodity prices. From an ESG perspective, we saw reaffirmed commitment towards net zero carbon emissions by 2050 at the COP26 summit, although sentiment amongst most participants suggests that more needs to be done. Locally, the South African Reserve Bank began its rate hiking cycle, which at the time surprised a few market participants, including myself, but in hindsight is proving to be a fair call. And while we saw the emergence of a new COVID-19 variant, Omicron, risk sentiment was hardly affected as the signs of a faster spreading but milder variant signaled a new era of the management of the pandemic. Which brings us to this past quarter, which has been nothing short of dismal for global markets. Growth stocks have fallen off a cliff in the wake of rising real rates, while the invasion of Ukraine by Russia and the subsequent sanctioning of Russia by the Western world has exacerbated an already volatile geopolitical environment, as well as the already sky-high energy prices. Locally, we saw 2 more rate hikes, with the SARB signaling more to come, while Enoch Gondongwana's maiden budget speech reaffirmed the positive boost to the fiscal position from mining tax revenue amid elevated commodity prices. At this time, we would like to extend our sympathies to all those affected by the Russian-Ukrainian war, and we hope for a resolution and end to the violence. We also extend our sympathies to any of you, your family, and friends who have been affected by the recent floods in KZN. Throughout this period, there has been one salient risk, and it has been climbing and climbing: inflation. Whether you are of the view that it is somewhat transitory and that the eventual easing of supply chains and increased productivity may result in these numbers unwinding, or you believe inflation is sustained, with inflation expectations unanchoring, inflation is now a perceived problem by global central banks. This is evidenced by the fact that a total of 23 central banks hiked rates in March, including the Fed and the SARB. And with the latest US inflation print coming in at 8.5%, the highest 12-month print in over 40 years, it is no surprise that the Fed, SARB, and other central banks are signaling further rate hikes in the coming months. It is easy as humans to get hung up on news headlines, particularly when it is bad. And often, Clients reading these headlines expect this bad news to be reflected in investment markets. While these can cause short-term spikes and excessive volatility, we need to remain grounded by the fundamentals, both company-specific and macroeconomic. This is well illustrated by this slide, showing the quarterly performances of the model portfolios over the past 12 months, where 3 out of the 4 quarters were positive, with Q4 2021 being particularly strong. At the start of this period, we were of the view that the extent of fiscal and monetary stimulus would support the global growth recovery, which would be positive for risk assets, aided by the increase in vaccination rates globally. Further to this, local asset class valuations were at very cheap levels, both in absolute and relative terms, and as a result, we favored local asset classes in the portfolios. This has certainly played out in markets. For the first quarter of this year, markets have, however, struggled, as my colleague and co-PM Ronnie has explained. Again, we may be hasty to attribute this to the Russian-Ukrainian war, but we expect its overall impact to be rather muted, barring any escalation in the war. Instead, we believe the changing fundamentals have been the greatest driver of market returns, with nominal and real interest rates rising as a result of changes in monetary policy to curb inflation pressures. Stretched valuations in global equity and bond markets have come under severe pressure. Similarly, while the war has impacted emerging markets, with Russian stocks being removed from the index, the underwhelming macro environment in China has been far more impactful, exacerbated recently by their zero-COVID policy amid rising case numbers. Local markets have been more resilient in the first quarter, and perhaps unsurprisingly, as valuations relative to global markets at the start of the quarter were much more favorable. As a result, local asset classes have been less affected by the changes in the global macro environment, and barring local property, they have all managed to deliver decent positive returns. This in turn helped limit the losses experienced in the portfolios. Turning now to the MFP Focus model portfolios. This slide shows how the portfolios have performed relative to their benchmarks and peers since their launch in April 2021, 1 year ago. It is important to note that as these are model portfolios, we have used the most appropriate peer group according to where the funds would appear if they were registered collective investment schemes. While the environment has been extremely volatile, as we've already discussed, we have taken advantage of the positive economic and market fundamentals, with all portfolios comfortably ahead of their benchmarks and peers, delivering returns between 10 and 14.5%. While this is a very short time period, we are encouraged by the ability of the portfolios to withstand the volatile market environment and deliver decent positive returns. However, given the short time period considered, it is important to manage your clients' future expectations of returns. Looking closer at our returns, this chart shows how the portfolios would have performed since their inception, assuming we invested passively and for free according to our strategic asset allocations. All local asset classes, barring cash, have been significant contributors to performance. Global equities contribution, which had also been significant throughout last year, is somewhat more muted given the recent correction. Just to remind you, the contribution from local bonds is much higher in the MFP Focus 3 model portfolio, given its more conservative nature and therefore higher allocation to local bonds. Similarly, as we move up the risk spectrum, the contribution from our growth assets increases. This slide also highlights the importance of asset allocation. Comparing these figures to the portfolio returns, we can see that this is by far the biggest driver of returns. We can also see that across the board, the strong market returns have driven the above benchmark returns of the portfolios. This table gives greater insight into our tactical calls. Overall, our tactical calls contributed to performance across the portfolios. The primary contributor across the portfolios has been our decision to favor local assets over global assets, with our overweight position in local equity and underweight position in global bonds the significant contributors. Although local bonds have delivered compelling absolute and real returns, with our overweight position contributing nicely to absolute performance, it has been overshadowed by the strong performance of local equity and property, which has therefore resulted in a negative tactical contribution from local bonds. Finally, this table shows the notable contributors to alpha and detractors from alpha from a manager selection perspective. Starting with our contributors, Momentum SA Flexible Fixed Interest remains a strong contributor, with its long duration position being the primary driver of its returns as the yield curve flattened. A-Lit Equity has benefited from its value bias, with value as a style continuing to outperform locally. although this was slightly impacted by its offshore allocation, particularly in the last quarter. Finally, Momentum Enhanced Yield continues to deliver stable outperformance relative to STEFI, with the fund benefiting from the continued contraction in credit spreads, while Momentum Core Equity's diversified style exposures have helped it deliver stable outperformance relative to the Cap 6. Our most notable detractors are all in the equity space, namely Fairtree Equity on the local front, and Momentum International Equity and Coronation Global Emerging Markets on the global front. On the global front, the Momentum and Coronation funds have both been hampered by their allocation to emerging markets, which has underperformed developed markets significantly. The Momentum Fund's diversified exposure to real assets, however, like infrastructure and property, have helped curb these losses. Finally, Fairtree's underweight to stocks whose share prices have increased significantly in the past 12 months, namely MTN, FirstRand, and Sasol, as explained by Core in our last session, has been the biggest driver of their underperformance. To conclude the presentation, this table shows our portfolio positioning at a mandate level. This does mean that the actual asset allocations of the portfolios may differ slightly as a result of managers' allocations to other asset classes such as cash or global assets. Looking ahead, we remain in favor of local assets over global assets. As mentioned earlier, as long as the Russia-Ukraine conflict remains regional and does not escalate into a global conflict, historical precedent indicates that its impact on financial markets should be temporary. We therefore believe the global policy pivot from stimulus to tightening will likely be the main fundamental constraint on global equity returns. Similarly, with this contributing to a rise in real and nominal yields amid more persistent inflation, global bond returns are likely to suffer. From a valuation perspective, however, we remain in favor of global equity over global bonds. Lastly, on the global front, we remain neutral on the outlook for global property, given the compelling yields it offers relative to both equity and bonds, and the fact that it has historically outperformed in times of heightened inflation. Turning to home, our bias to local assets is primarily driven by valuations, with local equity and bonds appearing cheap relative to history as well as to their global counterparts. We do, however, expect heightened volatility in both these asset classes as the global monetary policy is tightened and yields rise. We remain negative on the short-term outlook for local property as sector fundamentals remain negative, with rising vacancies, falling escalations, negative rental reversions, and sharp rises in operating costs leading to lower rental growth expectations. Similarly, while absolute returns from local cash have already increased and are expected to increase further in line with the SARB's hiking cycle, real rates remain poor relative to history and other asset classes. I hope you enjoyed the session. Once again, I thank you for your ongoing support and look forward to continuing on this journey with you and your clients to reach their financial objectives.
Hello everybody. So what's been going on in the world of fixed income? Well, really, it's been a rough ride through markets, through volatility, through geopolitical risk in Eastern Europe, and bond markets were not spared, especially over the last 3 to 6 months. And it really is about the Fed, and you've heard me say, look, it's going to be about the Fed in 2022, and it really is. And there's two very important aspects of the Fed. So if we move to the first slide is what we call the dot plot. So this is where the Fed governors say, well, where do they think interest rates in the US is going to be over the next 2 or 3 years? You can clearly see that line is now upsloping. It means that the Fed is in a rate hiking cycle. They have hiked rates, and the market is pricing that they will be hiking rates for most of 2022 and even into 2023. But is that the real reality? I think the risk actually is that the Fed could actually surprise us with steeper hikes, more hikes. Remember, initially we said the Fed will hike by 25 basis points at a time. Well, now the market is saying, well, inflation in the US is running at 8.5%. Maybe they should hike at 50 basis points increments at the following few meetings in 2022. And that's exactly what the Fed governors are saying in their dot plot. So watch this space. There's rates coming, rate hikes. Higher interest rates, higher bond yields, higher cost of capital in the world, right? So that's item number 1. What is item number 2? Why is the Fed so important?
Secondly, is because of, remember this great big word in the world, quantitative easing. Well, now we're reversing it. What does it mean? So over the last few years, the Fed built up a balance sheet of about $9 trillion, right? Helping bond markets, helping economies grow. What are they doing now? Now they're going to pull back on it. So how do they get it down? They have to sell bonds, not buy bonds. So the bigger question now is, how do the Fed get that $9 trillion balance sheet down to a more acceptable level over what period of time? Well, we'll have to hear, because they've not clearly said what they're going to do and how they're going to do it. How are they going to reduce bonds? How are they going to take that $9 trillion balance sheet and make it a $5 trillion balance sheet, a $2 trillion balance sheet? We don't know. It's going to have a material impact on global bond markets. Watch out in this space. It's important. It will affect us. What's happened to the US curve? The US bond market are anticipating these moves from the Fed. So what we've seen is the curve moves up, right? What we call a bear flattener. Now, what is a bear flattener? It means interest rates or bond yields are going up, right? As it expects the Fed to hike interest rates, inflation is going up, but the long end is coming down because the market is saying, well, if the Fed is hiking interest rates and it's pulling back on the balance sheet, well, growth is going to slow. In fact, it's going to slow dramatically. I think the US bond market is actually starting to worry quite a lot about what is going to happen to growth over the next year or more. Because remember, the Fed dot said the Fed is going to hike rates over the next 2 years, even into 2024. But is that the reality? What is happening? Now remember, a bond yield curve should always be steep, meaning longer rates should be higher than shorter rates because there's a thing called term premium. What are we seeing in the US? It's gone the other way. Shorter rates in the US are now higher than longer rates. Your 5-year rate in the US is now higher than your 10-year rate. Inverted curves. When you talk to economists about inverted curves, they go cold because it means one thing. Usually they would say, well, that would signal a recession. I'm not saying recession. But what I am saying is that the US bond market is telling us there is a slowdown coming. It's not going to happen today or tomorrow, but somewhere down the line, that US economy is going to slow down. The global economy is going to slow down. We're starting to see the proof of that. We're starting to see it in PMI numbers, in retail sales. I mean, the central banks are only starting to hike rates in developed markets. Yes, emerging market central banks have been hiking rates for probably more than a year now. But it says to us that developed market bond yields are now worried about what's going to happen in growth 2023, come 2024. Are central banks actually able to hike rates for the next 2 years? Bond curve doesn't seem to say that. If we look at the forward break even, what does the other side say? So the market says, well, we're worried about growth, and then there's this inflation measure called the forward break even, saying, what does the market believe average inflation over the next 5 years in the US to be? It says 2.5%, 2.52. It actually says the Fed will not be able to hike rates to contain inflation, because remember, the Fed has got a 2% inflation target. But it may not be able to contain the inflation because it may not be able to hike rates as far as the market believes it will do. So there's quite a bit of a challenge at the moment between inflation and what the central banks will be able to do. Right. Then we go across the water. What's happening in Europe? Well, we're all very versed in what's happened in Eastern Europe, and I'm not going to talk about geopolitics. What's important is what are the curves pricing. So remember, we all said the curves were flattening, but in Europe now, we're seeing the inverse. The curve is steepening, the flat end is falling. Why? Well, you can work out that there's not much that the ECB can do. You cannot hike interest rates when there's geopolitical risk on your eastern border. You cannot hike rates when there's all this uncertainty around energy prices that you import from Russia and wherever. So we think the ECB probably sits on its hands. So you've got a hiking Fed, hiking emerging market central banks, and you've got the ECB sitting on its hands, probably not being able to do much. So a very different profile for what's happening in European rates at this point in time. What's happened to bond yields? Well, we would not be surprised. So the US is hiking Bond yields are going up. We are in that interest rate environment where interest rates go up, inflation is already up. We've seen inflation rise dramatically over the last 6 months in the world. We've seen it in petrol prices locally. So we would not be surprised to see most of developed market bond yields going up, going much higher, pricing for this reality that central banks have to hike rates to reflect the inflation reality in the globe. What's emerging markets been doing? Well, I said to you, well, we're not surprised that over the last nearly 2 years now, emerging market central banks have been hiking rates, and they will continue to do so. So we've seen dramatic hikes, especially from the Central Bank of Russia, the Central Bank of Brazil. Our own SARB has already hiked a few times. We've seen hikes across most of the EM space. The only outsider is probably Turkey, doing some very weird and wonderful monetary policy by actually cutting rates in this environment. But we can probably expect this to continue. So interest rates are being hiked in most of the emerging market hemisphere, right? So we know that short rates are going up, long rates are going up. That's just the cycle of where we are in interest rates globally. So what's happening to our bonds? Well, if short rates go up, inflation has gone up. Would you be surprised that emerging market bond rates are going up? They are. Even here in South Africa, you know that a 10-year bond rate is probably trading closer to 10.5%. Not surprising because the SARB is in a hiking cycle. Our own inflation is closer to 6% at the recent measurement. So expect higher bond yields, but it doesn't mean that there isn't value in the bond market. We just think there's cheaper value in the bond market currently. So look at the bond market. So this is a South African curve. Now remember I said to you, most of the curves in the world are flattening, right? Doing this. The South African curve is still very steep, very different profile from a lot of other emerging markets and other developed markets. Why? Because we've been running with high interest rates through a long period of time. So think about it. In South Africa, inflation is probably going to be around 5.5%, 6% this year. Growth is probably going to be around 1.5%. And then you've got the 10-year bond yield at 10.5%. Well, that's probably about nearly 4% real. So there's a lot of fat, a lot of premium, a lot of negative news already built into the South African curve. So if you sit in normal cash and you think that, if I sit in a bank account, I'm probably going to earn 3 or 4% on my money. Well, you know, 10-year bonds at 10.5% and the long bonds at 11%. Well, we think they're great value. They've already priced for a lot of negative news in South Africa. Same for inflationary bonds. Are you worried about what's going to happen to the rand? We've seen the rand weaken a lot over the last short while. We've seen emerging market currencies take a lot of pain. Oil price still well above 100. Worried about inflation? Well, inflation bonds, there's your asset class that will protect you from the risk of inflation. If the rand blows out, petrol price goes higher, curve is still steep. We still think there's good value in South African bonds. We think that you should take your money out of cash, maybe a little bit out of credit even, and say, look, buy into South African bonds, buy into inflation bonds if you're worried. We've seen good returns from these asset classes over the last 2 years. It doesn't mean it will be repeated, but we still think that there's good real returns from these two asset classes over the next 2 to 3 years. Right, so what are the expected returns? So if you sit in South Africa and I've got cash in my pocket, I'm going to say, well, if I put my money in the bank account, I'm going to earn 3%, maybe 4% if I'm lucky. If I put it in my money market fund, well, maybe I'll earn 6.5% to 7.5%, maybe. If I put it in credit, I'm going to earn very much a similar spread because there's not a lot of fat or yield in the credit market. But hey, if I play into that steepness of the bond curve and the inflation bond curve, well, suddenly the returns look a lot more fatty and juicy. Suddenly we're talking 8.5 to 9.5, maybe even 10% returns from the bond market. Now that looks attractive to us in an economy that's probably only going to grow 1.5% this year, with an inflation targeting central bank around 6%. So yeah, we still think that nominal bonds and inflation bonds are our preferred asset class. Please don't sit in cash. Be wary of credit. And we think that duration is cheap in South Africa, so we would still advise our clients and our investors to invest in the duration asset classes in South Africa. Thank you.
Faria, who, as I mentioned earlier, is the head of product solutions, will now talk you through the new-to-market Guaranteed Annuity Portfolio. that will be available as an underlying investment component in the retirement income option.
Hello everyone, and welcome to what I think is a very, very exciting discussion today. It's a topic that we've been thinking about for a long time, and it's great to finally be able to come and talk to you about solutions where we can together help create better client outcomes. Now, there are a few themes that are core to how we at Momentum Investments approach enhancements in our business. Today, I want to share with you how we are bringing together partnerships, vertical integration, and digitization. Partnerships with clients and advisors to help them enhance the advice process. Vertical integration into our best solutions to solve real client needs, and packaging them together in an efficient and effective way using new approaches. So our focus in today's discussion is retirement income, and I want to cover three things. Firstly, just very quickly sketch the current environment and the problem statements. Then, to show how momentum is changing the current solution sets. And thirdly, to start showing you a little bit of what it means for advisors and clients in pursuing a really successful retirement. Now, for clients who reach the point at which they can retire from an investment, it has been a long accumulation journey. It's the result of saving, either in a retirement annuity or preservation fund, or an employer-sponsored retirement fund for many years. Regulation requires that a client must use some of this money to invest in an approved income product. The current options available to clients and advisors are a life annuity or a living annuity, and both have benefits and drawbacks. With a living annuity, a client can tailor their income by choosing an income level between 2.5% and 17.5% of the investment value, which they can adjust every year. They also have the flexibility to choose investment components to suit their own investment strategy. But if they don't strike the right balance between life and living expenses, there is a risk of running out of money to pay for even the bare necessities. And even if you do strike the right balance, there are things that are out of our control. The risk of markets giving low or negative returns, higher than expected inflation, and medical advances that result in people living longer all pose a significant risk to someone's ability to maintain their standard of living. Clients who choose a living annuity often think that the main risk is to die earlier than expected, in which case they want to be certain to leave some money for their beneficiaries. What they often understate is the risk of negative inheritance. If a client lives longer than expected and runs out of money, then instead of leaving an inheritance to his dependents, which is often punted as one of the main benefits of a living annuity, he in fact becomes dependent on his family members, hence the negative inheritance. A life annuity pays a guaranteed income for life, so it provides a great match for a client's basic expenses. The client is not exposed to market volatility or the risk of living longer than expected. Therefore, it is the purest form of protecting income. But it lacks the flexibility that some people may require to provide for the more variable living expenses. Now, you've heard me say the words living and life expenses, and those relate to the true client need in retirement. What a client really needs is to match his expenses during retirement. Basic life expenses include things like having a place to live, medical aid, groceries, and other regular essential spending. Living expenses, on the other hand, include things like paying for holiday, starting a small venture, contributing to a special life event. But these living expenses always come after the life expenses. Depending on the client involved, they may or may not have enough to cover emergencies. So this is an additional factor to consider. And then lastly, there may be a need to leave an inheritance. And even though it often features quite strongly, leaving an inheritance should always come after a client has covered the rest of his expenses. So the relative importance of these needs are a function of how much a client has saved before retirement, either inside a retirement savings product or outside through other asset accumulation. That is what the need is in retirement. What it actually becomes is a balancing act between risk and reward. It's about the risk of living longer than expected versus the risk of living shorter than expected. The risk of volatility in investment markets can reduce capital versus the potential for market growth that actually increases capital values. The risk of low investment returns eating into capital versus the possibility of higher investment returns that provide greater income and capital opportunities in the future. A key decision that is being made here is about the sharing of risk. In a living annuity, the client takes on the reward, but also all of the risk, investment and longevity risk, by himself. On the other side of the spectrum, in a life annuity, the client outsources all risk, investment and longevity risk, to the insurance company. This sharing of risk decision becomes much harder when you realize that in most cases, it's made at the time of retirement. A once-off decision that affects the income that a client should receive for the rest of their life. 5 years ago, the split between living and life annuities was roughly 90-10. Recently, it has been closer to 70-30. Now, there's a variety of reasons that could be driving this. Retirement reform has made people aware of guaranteed annuities much more than they were before. The volatility in the pandemic was also a scare for many retired clients. Lots of them experienced capital losses and then switched out of the investment and locked into these losses. Over 3 billion rand was switched on the retirement income option over the last 2 calendar years, resulting in an average behavior tax of 5%. The impact on a client of this type of behavior is something he's unlikely to recover from. And the question is really why? Why is there only an all or nothing option or a cumbersome process in between? To answer this challenge, we have reimagined a retirement income solution in line with the potential needs of all clients. The construction started with setting up a protected portion of income that provides a guaranteed income irrespective of market movements. To tie it up with the discussion earlier, it is a good match for the expenses that a client must meet every month. The guaranteed income is provided through a guaranteed annuity portfolio that can be personalized by choosing annual income increases which protect the real value of the income and reduce the inflation risk. It can also incorporate a guarantee term and a joint life option in order to perhaps partially meet the need to leave an inheritance. The growth portion can be invested to increase the capital value and offer more flexibility of income, so it's a good match for expenses above the basic needs. The more it grows, the more optionality a client has, both for drawing an income and for leaving a legacy. Now, the growth portion has exactly the same functionality as it currently does on the retirement income option, and the advisor can choose from any of the underlying investment components available. What we are introducing today is the Guaranteed Annuity Portfolio as a new optional component on the living annuity. The balance between growth and protection is left to each individual. Now, a few core product features. There will be no administration fees paid on the Guaranteed Annuity Portfolio. The initial investment amount invested into the Guaranteed Annuity Portfolio will be included for aggregation purposes to calculate the fee a client will pay both on the growth portion and potentially other momentum wealth contracts. So overall, this contributes in 2 ways. Firstly, no administration fees applicable. And secondly, it could potentially decrease the fee payable on other assets. ongoing advice fees will be paid on both the growth portion and the initial guaranteed annuity portfolio value. Since the guaranteed annuity portfolio is not a liquid component, the fees will be calculated on the whole contract, but only deducted from the linked assets. The level of advice fees will be unchanged until the guaranteed annuity portfolio reaches 50% of the contract value. Above that, there will be a cap on the amount paid on the guaranteed annuity portfolio value. As you can see from the structure, one contract includes all these benefits. That means that as an advisor using both types of components, you will only need to follow one process. The guaranteed annuity portfolio will be illustrated in an integrated way into the same living annuity proposal that you are familiar with. The same application process for the retirement income option will also be followed, and there are no additional steps that you will be subject to. In addition, everything will be available online, so you can be certain that you will have the most updated pricing and efficient, easy-to-follow processes when delivering the solution to your clients. This single contract that the client has is legally a living annuity and subject to the income rules of the living annuity. To explain the impact of a guaranteed annuity portfolio in the contract, we can start at the right of the screen. The guaranteed income will be paid out on a monthly basis into a default money market fund that we call the life income money market. Importantly, there will be no tax deducted from the income at this stage. The income then becomes available on the contract. Income drawdowns are taken from the growth portion. As you can see from the illustration, the life income money market becomes part of the growth portion, and its purpose is only to receive the monthly amount from the guaranteed annuity portfolio. The income that a client receives must be between 2.5% and 17.5% of the total investment value. We will deduct tax from the income based on standard rules before we pay it out to the client. The amount paid out will first be taken from the money market and thereafter from the components specified by the advisor. So why is all of this important? And how does it really lead to better client outcomes? There are 3 reasons that I want to talk to you about today. Firstly, because it enhances the advice opportunity set. Usually in a standalone life annuity, advice fees are paid upfront, and that's the end of the relationship between the client and the advisor. The structure of the guaranteed annuity portfolio as a component in the living annuity allows an advisor to continue to be involved in advising his client. For example, around how to manage expenses in the context of returns, when to protect income, how much income to protect. Now, earlier I mentioned that in a living annuity, a client typically takes on all the risk and all the reward, while in a life annuity, he outsources all the risk to the life insurer. What the new structure of the living annuity allows is the flexibility for a client and advisor to decide when to share risk and how much risk to share. It goes even further because a client can now lock in to future income increases. So the exposure to investment risk, inflation risk, and mortality risk can all be reduced. At the same time, the client can retain some exposure and some possibility of upside potential on investment growth. Insurers are the experts in longevity pricing and prediction, and momentum is the best possible partner for managing uncertainty. The guaranteed annuity portfolio will be open for new and existing retirement income option clients. This means that for your existing clients in the living annuity, you can also decide when and how much income to protect by switching into a guaranteed annuity portfolio. It also means that we've taken away the pressure of making this decision once off. For some clients, a living annuity is an easy answer at retirement, perhaps even the right choice to give them some time to accumulate more assets. So you will have the option to choose to protect some of the client's income at the time when it makes most sense for that client's circumstances. And we have aligned our advice fees to be relevant for this enhanced advice opportunity. All of this is really just another way that we at Momentum Investments are making retirement income choices very personal. The second reason that this is important is that there is a different type of diversification benefit. The Guaranteed Annuity Portfolio, as part of a living annuity contract, introduces a very different type of asset class with a very different type of return profile. It's an insurance contract, so the underlying return is a function of both the guaranteed return and how long the client lives, and not only the investment return the way we are familiar with for other asset classes. For example, let's consider a 65-year-old client in a guaranteed income product where their income increases at 5% every year. This client will more or less receive the investment back after 10 years. So by age 75, they will have recovered all their capital. Thereafter, they will receive the investment amount back again every 2 to 3 years. So much so that someone who lives till, say, 95 will have received in income more than 5 times the amount that they initially invested. Now, an interesting angle to think about is how a guarantee term changes the profile. For example, in the graph on the left, you see that a client who receives an income for 20 years receives 250% of what he initially put in. And that translates into an internal rate of return of just over 10%. That is an attractive guaranteed profile because it is not subject to any market movements at all. Now, a client who adds a guarantee term of 20 years can actually lock into this as a minimum return. Of course, you as the advisor will need to consider this in the context of the change in income that a guarantee term introduces, which depends on your client's age. Another factor to consider is the consequent impact on the asset allocation of the remaining assets. By introducing protection on a portion of the income, the advisor may choose to pursue a more aggressive asset strategy on the market-linked assets with a view to achieving higher growth rates on that part of the investment. So including a guaranteed annuity portfolio can have an impact on how an advisor views investment risk on the balance of the portfolio. And these are some of the diversification benefits that the new structure enables. The third reason why our new structure is important is because it increases the likelihood of success in retirement. Now, what is success in retirement? The answer is probably different for each client. For very high net worth clients, the aim is likely to increase the capital value, draw the minimum income possible in order to leave a legacy. But for most clients, success will be to maintain the real value of the income they receive for as long as they live. So, if a client's income can always keep pace with inflation and does not run out during his lifetime, then he will have achieved a successful retirement. The reality is that many clients have not saved enough for retirement. Combine that with a low return environment, and it actually becomes very difficult to be confident of a successful retirement. Including a protected income means that a client will never run out of money. On at least a portion of their income, they can be certain of this outcome. And including this in a strategy allows the advisor to ensure that even if the circumstances result in the client's income decreasing, there is still a floor below which he will not be at risk. I would like to share with you a sneak peek of analysis that our marketing actuary, Martins Barnard, has done, which will illustrate these impacts. Let's look at an average case study where the client is aged 65 and has 2 million rand to invest in a living annuity. Let's assume that he needs an income of about 140,000 rand every year, increasing at 5% per annum. This translates to a drawdown rate of 7% from the living annuity in year 1. Let's further assume that 50% of this client's expenses are fixed life expenses, while 50% are more variable living expenses. The graph on the screen projects the income that the client needs should they live till age 100. Now, Martins ran 2,000 return simulations that showed that in 40% of cases, the best scenario would be that the client's income can be met till age 83. Thereafter, the income starts to drop. From age 89 onwards, this client's income will have dropped to less than half of what he needs, which means that from age 89, he will not even be able to cover the basic life expenses that he has. This is a real example of negative inheritance. Now, what happens to this profile if you add a guaranteed annuity portfolio with 35% of the investment amount? 2 important effects. 1, instead of starting to reduce after age 83, the income only started to reduce at age 94. So it gave the client an extra few years of receiving the full income that he required. Secondly, you can see that there is no red line. This means that even though his income reduced at these older ages, it was always more than the 50% of what he needed. Most importantly, if you look at the profile, the client was always able to meet his life expenses. Now, including a guaranteed annuity portfolio in a living annuity does not mean that a client will always receive the income that he requires. There will still be situations where a client has not saved enough for retirement, and the income that he can expect will reduce. What the guaranteed annuity portfolio does is that it limits the extent to which the income can fall and basically sets an income floor for the client. And depending on the scenario, it can extend the time before the income starts to fall. What you see on the screen now is the result of the 2,000 simulations, assuming no guaranteed annuity portfolio and a medium equity investment strategy. The green shaded area is where the client can meet all his income needs. The yellow shaded area means that a client's income will be less than 100% of what he needs, but more than his life expenses of 50%. And the red area is where the client cannot meet his life expenses because his income is less than 50% of what he needs. The dotted lines show the 40% and 20% likelihood areas. The next picture shows the impact that a 35% investment into a guaranteed annuity portfolio has. Look at how the green area becomes bigger. More importantly, note carefully how the red area shrinks. This means that by including a 35% guaranteed annuity portfolio in this client's living annuity, we could help him to be certain about meeting his life expenses for an extra 11 years. If you use a 50% investment in a guaranteed annuity portfolio, the red area disappears completely. The power of this effect depends on the circumstances, and Momentum Investments will be sharing more thought-provoking analysis to show the trade-offs in different types of investment constructs and how an advisor can start to limit the client's risk in these situations, and really how we can work together to help our clients achieve more successful outcomes in retirement. To summarize, Momentum Investments is bringing out enhancements to our existing living annuity solution through the addition of a guaranteed annuity portfolio as an option in the construct. We anticipate that this will result in more opportunities for advice relationships and discussions. It also introduces a new type of asset class in considering how to match client income profiles. Over the next few weeks, you will see information around training opportunities and where you can access all the relevant material to understand these and other issues. We are really looking forward to a partnership with each of you as we together help your clients achieve a successful retirement based on their personal needs.
Just a quick reminder of the specialists available for assistance. On the MFP model portfolios, Rupert Giesing and Emily Mahoku for Momentum Fixed Income and Fund of Funds Solutions. I want to end this session with a quote from Winston Churchill. To each, there comes in their lifetime a special moment when they are figuratively tapped on the shoulder and offered the chance to do a very special thing, unique to them and fitted to their talents. What a tragedy if that moment finds them unprepared or unqualified for that which could have been their finest hour. Your job as a financial advisor is to be the financial advisor for your client. Focus on the task at hand and use the investment solutions that were designed by the specialists and create a finest hour in your journey with the client to financial wellness. I wish you luck, and I want to thank you for your attendance. Enjoy the rest of your day and stay safe.